Welcome to our deep dive on Sony's 2026 Q4 financial performance. This quarter, Sony reported revenue of $25.3 billion, marking a 4.5% increase year over year. Net income stood at $2.1 billion, with earnings per share reaching $1.75, slightly beating market expectations. Today, we'll unpack what these headline figures mean within the broader market context and explore the key financial and strategic takeaways.
Absolutely, Shekhar. This quarter is particularly significant as Sony navigates both macroeconomic uncertainties and intensifying competition across its diversified segments. The steady revenue growth, coupled with resilient profitability, suggests operational strength. But we'll be watching how this quarter sets the tone for upcoming regime shifts. We'll also analyze underlying cash flow dynamics and working capital efficiency to understand the quality of earnings in today's challenging environment.
From a practical standpoint, these numbers are more than just data points. They signal how well Sony is positioning itself against peers and managing risks. Investors want to know if this momentum is sustainable, especially with ongoing supply chain pressures and emerging tech disruptions. Over the episode, we'll cut through the noise with data-backed insights and close with actionable recommendations for both investors and company leadership.
Diving into Sony's financials for Q4 2026, we see revenue at $25.3 billion, up 4.5% year over year. This marks a slight acceleration compared to the 3.8% growth in Q3. Net income came in at $2.1 billion, representing an 8% increase sequentially, and a notable improvement from $1.95 billion in the prior quarter.
Right, Shekhar. This steady upward trend is also reflected in earnings per share, which rose to $1.75 from $1.62 last quarter, showing a 7.7% jump. Importantly, Sony's adjusted EPS beats market consensus by 3 cents, signaling solid operational execution despite ongoing margin pressures in some segments.
From a CFO perspective, this growth is encouraging, but we need to look under the hood. Operating cash flow was $3.2 billion this quarter, down slightly from $3.3 billion in Q3. That dip indicates some cash conversion headwinds, possibly tied to working capital or higher CapEx, factors investors should watch closely.
Indeed, Raj. On leverage, Sony's net debt increased marginally to $9.7 billion from $9.4 billion last quarter, maintaining a net debt-to-EBITDA ratio of 1.8x, well within the company's target range. Interest coverage ratio remains healthy at 9.2x, reflecting strong earnings support for debt servicing.
Adding to that, liquidity metrics are solid, with cash and equivalents holding steady at $6.3 billion. The company's free cash flow, however, declined slightly to $1.4 billion from $1.6 billion in Q3, driven by an uptick in capital expenditures related to R&D and digital transformation initiatives.
Those investments make sense strategically, but from a financial health angle, sustaining margin and cash flow while ramping CapEx is tricky. Sony's gross margin held firm at 32.5%, flat quarter over quarter, but operating margin compressed slightly to 11.2% from 11.5%, largely due to higher input costs and increased SG&A spend.
Comparing to peers, Sony's revenue growth is modestly ahead of the industry average of 3.7%, while its leverage ratio is more conservative than peers like Samsung Electronics, which reported a 2.2 times net debt to EBITDA ratio last quarter. This suggests Sony is balancing growth with financial prudence effectively.
Furthermore, Sony's EPS trajectory is notable for its consistency over the past 4 quarters, averaging a 6% quarter-over-quarter increase. This contrasts with some peers experiencing more volatility due to exposure to cyclical components in the tech space. Sony's diversified revenue streams help stabilize earnings.
Yet, there's a cautionary note on the slight decline in operating cash flow and free cash flow margins. If working capital trends deteriorate or CapEx escalates beyond forecast, the firm could face liquidity constraints that limit strategic flexibility. That's something management needs to monitor closely in the coming quarters.
To summarize, Sony's Q4 financial health is robust with solid revenue growth, improving net income, and disciplined leverage management. The company's balance sheet supports continued investment while maintaining a strong credit profile. Our deep dive confirms a positive trajectory, but flags working capital and margin pressures as areas to watch closely moving forward. Let's shift our focus to the key inflection points that have shaped Sony's recent performance. One notable regime change is the company's intensified investment in digital transformation, which is reflected in the increased R&D spend this quarter. This pivot is aimed at strengthening their software and services ecosystem to complement their hardware segments.
Exactly, Shekhar. The numbers back that up. Capital expenditures related to digital initiatives rose by 12% quarter over quarter, marking a deliberate shift from traditional product lines toward more scalable, recurring revenue streams. This strategic pivot aligns with the broader industry trend of integrating content, cloud, and platform services.
From a CFO standpoint, that pivot is a double-edged sword. While the ramp-up in digital investments positions Sony well for future growth, it also weighs on short-term free cash flow and operating margins. We've seen the operating margin dip to 11.2% this quarter, primarily driven by this increased SG&A and R&D spend. The challenge is balancing this investment with near-term profitability.
Another critical inflection point is Sony's recent strategic realignment in its gaming division. The launch of the new PlayStation VR2 model this quarter is a key catalyst. Although it came with one-off marketing and production costs, it positions Sony ahead of competitors in the immersive gaming segment, a market expected to grow at over 20% annually.
Yes, the VR2 launch contributed to a noticeable uptick in gaming revenue, up 6% quarter over quarter, which partially offset softness in the electronics segment. However, we also observe that the increased DIO in the gaming segment suggests inventory buildup as Sony prepares for expected demand ramp in the next quarters, hinting at a deliberate push to capture market share.
This inventory strategy does come with risks, especially if consumer uptake is slower than anticipated. Holding higher inventory increases working capital tied up and could pressure cash conversion cycles. But if successful, it would fuel higher margins downstream through premium pricing and services integration, a classic trade-off in product launches.
Additionally, we can't overlook Sony's recent acquisition of a cloud gaming startup, which is a strategic move to accelerate their entry into the cloud-based content delivery space.
This acquisition is still in its early integration phase, but could signal a longer-term regime shift toward platform-driven revenues and reduced hardware dependency.
From a financial perspective, the acquisition added a $150 million one-off cost this quarter, impacting net income slightly. But the synergy potential is significant. If executed well, this could improve Sony's EBITDA margins by 100 to 150 basis points over the next 2 to 3 years, especially as cloud services have higher gross margins compared to hardware.
Strategically, Sony is navigating a complex competitive landscape where diversification and innovation are critical. However, these shifts increase execution risk, particularly with supply chain volatility and fluctuating consumer demand post-pandemic. Management's ability to deliver on these initiatives while controlling costs will be decisive.
In sum, these regime changes, from the digital transformation and gaming innovation to strategic acquisitions, mark significant inflection points in Sony's growth trajectory. They introduce both opportunity and risk, but if managed adeptly, they could reshape Sony's financial profile towards more sustainable, higher-margin revenue streams.
Let's begin with Sony's working capital metrics for Q4. Days Sales Outstanding, DSO, held steady at 38 days, essentially flat from 37 days last quarter, indicating consistent collection efficiency across the board.
Right. Priya. That stability in DSO suggests Sony is maintaining tight credit terms despite the macroeconomic uncertainty. It's a solid indicator of receivables quality, which supports predictable cash inflows.
Moving on to Days Inventory Outstanding, DIO, we see a notable increase to 65 days from 58 days in Q3. This 7-day jump is largely driven by the gaming division, aligning with the inventory buildup ahead of the PlayStation VR2 demand ramp.
That inventory buildup is a double-edged sword. On one hand, it shows Sony's confidence in product uptake. On the other, it ties up significant cash and increases risk if sales don't materialize as expected, especially given higher input costs and supply chain pressures.
Indeed, Raj. From a working capital management standpoint, rising DIO lengthens the cash conversion cycle, which was 42 days last quarter, but increased to 45 days this quarter. While modest, it does impact liquidity and increases the cost of capital tied up in inventory.
Meanwhile, Days Payables Outstanding, DPO, ticked up slightly to 58 days from 56 days. Sony is extending payables cautiously but not aggressively, which contrasts with some industry peers who are pushing DPO well beyond 60 days to conserve cash.
That's a critical point. Sony's balanced approach on payables avoids straining supplier relationships, which is essential given the complex component supply chains. But it also means they can't rely heavily on payables to offset inventory and receivables pressure.
When we benchmark these figures, Sony's cash conversion cycle of 45 days is slightly higher than Samsung Electronics, which reported around 40 days. Samsung's tighter inventory management and more aggressive payables strategy give it a liquidity edge, though at the potential cost of supplier tension.
Correct. The increased DIO is the main driver of Sony's working capital elongation this quarter. And while DSO and DPO remain stable, that inventory focus reflects the strategic choice to prioritize market share and product readiness over immediate cash flow optimization.
From a CFO's perspective, this inventory-driven working capital expansion is a risk worth monitoring. If end market demand softens or supply chain disruptions occur, Sony could face cash flow headwinds that limit agility, especially as CapEx is also elevated.
To sum up, Sony's working capital management shows operational discipline on receivables and payables, but the strategic inventory increase is creating some cash conversion cycle pressure. This is a classic trade-off between growth investment and liquidity that management must carefully balance going forward. Let's break down Sony's margin performance this quarter, starting with the gross margin, which held steady at 32.5%. This flat performance quarter over quarter is notable given the inflationary pressures and input costs we've seen across the tech industry.
Right, Shekhar. While gross margin stability is encouraging, the operating margin took a slight hit, coming in at 11.2% versus 11.5% last quarter. This 30 basis point compression primarily reflects increased SG&A expenses and elevated R&D investments, particularly in the digital transformation initiatives we discussed earlier.
From a CFO's lens, that operating margin compression makes sense as a short-term trade-off. Sony is clearly investing ahead of the curve, but the challenge will be maintaining profitability while these costs ramp up. Sustaining operating leverage under such spending pressure is no small feat.
Looking deeper at the segment-level drivers, gaming remains a bright spot. The 6% quarter-over-quarter increase in gaming revenue is a key contributor to overall margin support. The higher-margin software and services revenue in this division help offset softness in the electronics segment, where margins are under pressure due to component cost inflation and pricing competition.
Exactly. The shift in revenue mix towards software and services within gaming enhances margin sustainability. Gaming's gross margin outpaces the corporate average, estimated around 38%, compared to electronics hovering closer to 28%. This dynamic partly explains the gross margin resilience despite cost headwinds elsewhere.
However, the softness in electronics is concerning because it represents a significant revenue chunk. Increased input costs there squeeze margins, and pricing power is limited due to intense competition. Unless Sony can optimize supply chain efficiency or increase prices selectively, operating margins could stay pressured in this segment.
On cost control, while input costs are rising, Sony's productivity improvements and scale benefits are helping mitigate the impact. For example, the company improved manufacturing automation and logistics optimization, which shaved approximately 50 basis points off cost of goods sold compared to last year.
Those productivity gains are vital, especially given the 12% increase in R&D spend this quarter. This investment underpins future margin expansion by enabling new product development and platform enhancements. The key question is whether these initiatives translate into higher margin revenue streams over the medium term.
A critical risk to watch is the balance between investing for growth and protecting margins. If market conditions deteriorate, Sony might be forced to dial back R&D or marketing spend, which could slow innovation. Conversely, maintaining heavy investment without revenue acceleration risks margin erosion and cash flow strain.
Comparing Sony to peers, its gross margin outperforms the industry average of around 30%, with operating margins in line with competitors like Samsung at roughly 11 to 12%. Sony's diversified business model and focus on higher-margin digital content provide a buffer. However, margin volatility remains a risk given the mix of hardware and software. When we talk about Sony's strategic risk landscape, supply chain vulnerabilities remain front and center. Despite improvements, ongoing component shortages and logistics bottlenecks could disrupt product launches, especially with the ramp-up in gaming hardware like the PlayStation VR 2. Additionally, macroeconomic headwinds such as persistent inflation and interest rate volatility create a challenging environment for cost control and capital allocation.
Adding to that, currency fluctuations present a nuanced risk for Sony, given its global footprint. The yen's recent volatility against the dollar has squeezed margins, and geopolitical tensions in key markets like China and Southeast Asia add layers of uncertainty. Sony's diversified revenue helps mitigate single market exposure, but these factors could introduce earnings variability, particularly if trade restrictions or tariffs intensify.
Those risks are real, but I'd caution against assuming Sony's current mitigation strategies are bulletproof. The company's balanced payables approach and moderate leverage leave some financial flexibility, but the rising working capital tied up in inventory and CapEx commitments mean less wiggle room if supply chain shocks worsen. Plus, the competitive landscape is heating up with aggressive moves from both established peers and nimble startups in cloud gaming and immersive tech.
On the opportunity side, Sony's push into digital transformation and new product categories is promising. The increased R&D spend and strategic acquisitions in cloud gaming position the company to capture higher-margin, recurring revenue streams. Moreover, emerging markets remain underpenetrated for Sony, offering significant growth potential as digital infrastructure improves and consumer spending power increases.
Indeed, data supports this optimism. The cloud gaming market alone is forecasted to grow at a CAGR exceeding 25% over the next 5 years, which aligns well with Sony's acquisition and platform strategy. Their growing software and services revenue, now contributing a meaningful portion of gaming division profits, provides a buffer against hardware cyclicality and margin pressures. However, successful scaling will depend on seamless integration and sustained user engagement.
Strategically, the key challenge will be execution discipline. Balancing near-term margin pressure from elevated SG&A and CapEx with long-term innovation is no small feat. Sony must avoid the trap of overextending on investments without clear visibility on returns, especially in volatile global markets. Investors and management alike need to keep a close eye on how these risks and opportunities evolve, ensuring that the company maintains both agility and financial resilience.
When we position Sony within its broader industry ecosystem, a few strengths stand out clearly. The company's diversified portfolio, from hardware like PlayStation and imaging sensors to digital content and services, gives it a multi-pronged revenue base that few competitors can match. This diversification helps buffer Sony against volatility in any single segment and supports stable cash flow generation.
Absolutely, Shekhar. Market share data confirms this resilience. Sony's gaming division, boosted by the recent PlayStation VR2 launch, now accounts for approximately 40% of total revenue, up from 37% last year. This segment's shift towards higher-margin software and subscription services is giving Sony an edge over peers like Microsoft and Nintendo, who face different competitive pressures in platform ecosystems.
From a CFO standpoint, that gaming dominance is both a strength and a vulnerability. While Sony's brand equity and innovation leadership in immersive gaming are impressive, emerging competitors in cloud gaming and subscription-based models, such as Google Stadia and Amazon Luna, pose disruptive threats. Sony's recent cloud gaming acquisition is a smart move, but they need to accelerate integration to avoid losing ground.
Good point, Raj. Additionally, Sony's brand strength in consumer electronics, especially imaging sensors used in smartphones, cements its B2B relationships with major device makers, creating a high barrier to entry for new competitors. However, the electronics segment faces margin pressure from commoditization and aggressive pricing by rivals like Samsung and Apple's internal developments.
Indeed, that margin pressure in electronics is a key challenge. Sony's gross margins here are roughly 28%, noticeably below its corporate average. Yet the company's investments in R&D and supply chain optimization are designed to maintain technological leadership, particularly in sensor quality and miniaturization. If successful, this could allow Sony to sustain or even grow market share, despite fierce competition.
Strategically, Sony is walking a tightrope, leveraging innovation and brand equity to maintain leadership, while defending against fast-moving disruptors in cloud gaming and device components. Execution discipline will be critical, especially managing working capital tied up in new product launches and balancing CapEx with returns. For investors and management, watching how Sony navigates these industry shifts will be crucial to assessing its competitive durability going forward.
To wrap up, Sony's recent quarter demonstrates robust top-line growth and disciplined leverage management, which underpin a fundamentally sound financial profile. The company's strategic pivot toward digital services and cloud gaming marks a pivotal evolution from traditional hardware dependence, positioning it well for higher-margin, recurring revenue streams. However, margin pressures and working capital expansion tied to inventory buildup highlight near-term execution risks.
From an analytical standpoint, the key metrics to monitor in upcoming quarters are operating margin trends, especially whether the elevated R&D and SG&A spend translates into sustained revenue growth, and working capital efficiency, particularly any shifts in DIO and cash conversion cycle. Additionally, integration progress of the cloud gaming acquisition will be a critical barometer for assessing longer-term EBITDA margin expansion and competitive positioning.
Given the data and strategic landscape, my view is a cautious buy. Sony's innovation pipeline and diversified revenue base provide a solid foundation, but investors and management must remain vigilant on cash flow dynamics and margin sustainability. Executives should prioritize disciplined capital allocation and maintain flexibility to adapt to market or supply chain shocks. For investors, watch for quarterly signals on cash flow stabilization and margin recovery. Those will be the clearest indicators of whether Sony can deliver on its digital transformation promise while protecting profitability.